You're about to hear the 10 US stocks that could move portfolios this November, with clean fundamentals and one clear thing to watch for at every ticker. Two of these names look meaningfully cheaper than fair value models say they should be. One is priced for perfection and will punish a single miss, and one is a high-yield hedge if the macro turns ugly. If you want fast, actionable market ideas, hit like and subscribe to Seven Hills Equities. We cut the noise so you can trade with confidence. Quick note, this video is for informational and entertainment purposes only and is not financial advice. Always do your own research or consult a licensed advisor. Number 10. Chevron, ticker CVX. Chevron is trading in the upper 150s as of October 31st, 2025, and it currently carries a mid-teens price-to-earnings ratio that reflects steady upstream cash flows and recent production gains. The company pays a healthy dividend that yields roughly 4%, which makes Chevron attractive to income-oriented investors who also want energy exposure. Morningstar's coverage places Chevron's fair value in a band that is generally close to the market price today, implying the stock is roughly fairly valued to slightly undervalued, depending on oil price assumptions. Our DCF take is simple. If oil prices hold near current levels and Chevron sustains production, the firm's intrinsic cash flow supports the stock's dividend and buyback profile, making Chevron a tactical overweight for macro hedge allocations. Number 9. JP Morgan Chase, ticker JPM. JP Morgan is trading near the low 300s as of October 31st, 2025, and it shows a low to mid-teens trailing PE that reflects the bank's diversified revenue mix across consumer, corporate, and trading businesses. The bank yields around 2% from its dividend and has a solid tangible book cushion on the balance sheet. Morningstar's fair value work suggests limited upside unless net interest margins or trading revenues surprise to the upside, so the bank is a core holding unless macro deteriorates type of name. From a DCF perspective, JP Morgan's intrinsic value is highly sensitive to interest rate and credit assumptions, so the practical trade is to watch the next quarter's net interest margin guidance and loan loss reserve commentary. A small beat there re-rates the stock quickly. Number 8. Eli Lilly, ticker LLY. Eli Lilly is trading in the high hundreds as of October 31st, 2025, and its trailing PE is elevated relative to the market because investors are paying for rapid EPS growth driven by recent drug launches. The company pays a small dividend, but the valuation is primarily a growth multiple tied to the success and international rollout of obesity and diabetes therapies. Morningstar's analysts have shifted fair value estimates higher after strong commercial uptake for leading drugs, which supports a continued premium. Our DCF conclusion. Lilly's intrinsic value benefits materially from sustained blockbuster drug sales, but pipeline or pricing setbacks are the primary downside risk. This is a growth with defensive healthcare tilt, best sized for conviction and catalyst-driven risk. Number 7. Meta Platforms, ticker Meta. Meta is trading in the mid to high 600s as of October 31st, 2025, and it sits on a multiple that looks like a mature tech business rather than a speculative growth-only name. The company carries meaningful capex for AI infrastructure, which compresses short-term free cash flow even while it funds potential long-term monetization. Morningstar's fair value analysis shows that Meta's current price sits close to intrinsic estimates under moderate capex assumptions, but the margin of safety disappears if capex rises faster than monetization. Our DCF take. If Meta monetizes Reels and new AI products at scale this holiday season, the intrinsic value lifts sharply. If ad demand softens or capex cannibalizes cash flow, multiples compress, so watch ad spend and monetization metrics closely. Number 6. Tesla, ticker TSLA. Tesla remains volatile and as of October 31st, 2025 was trading in the mid to high hundreds per share, with a trailing PE that is extremely high compared with legacy automakers because investors are valuing future autonomy and robotaxi optionality. Tesla pays no dividend and its valuation is largely a multiple on expected future growth and new business lines. Morningstar and major coverage show that in several base case DCF scenarios, Tesla can be priced above intrinsic value unless the company delivers new revenue streams from autonomy or substantial margin gains in vehicle manufacturing. Our DCF verdict: Tesla is a high upside, high risk name best used as a conviction trade with tight execution watch points, watch delivery numbers, and any credible autonomy milestones as the decisive triggers. Mid-roll reminder: if you're getting value, hit like and subscribe to Seven Hills Equities. Number 5. Alphabet, tickers Google, Goog. Alphabet is trading in the high 200s as of October 31, 2025, and it carries a moderate trailing PE for a large-cap tech name, with a small yield supporting total shareholder return. Alphabet's core ad business still generates strong free cash flow, while Google Cloud represents a margin recovery story that can materially change long-term cash flow forecasts. Morningstar's fair value modeling places Alphabet roughly near fair value under conservative cloud margin assumptions and above fair value in scenarios where cloud margins accelerate. The DCF implication is straightforward. Positive cloud margin surprises and resilient ad demand increase Alphabet's intrinsic value materially. So the actionable watch is cloud margin trajectory and holiday ad performance. Number 4. Amazon, ticker AMZN. Amazon is trading in the low to mid 200s as of October 31, 2025, and its headline multiples look elevated when you compare it to retail peers, but far more attractive when you isolate AWS as a high-margin cash generator. Amazon pays no dividend, and much of the valuation story rests on AWS re-acceleration plus improved operating leverage in retail. Morningstar's price versus fair value work recently moved Amazon into a fair value to slightly undervalued zone for some models thanks to AWS recovery, which supports an intrinsic value upside in scenarios where cloud growth sustains. The DCF takeaway is simple. If AWS continues to re-accelerate into holiday season and operating margins improve, Amazon's intrinsic value will move higher quickly. If AWS stalls, the stock is much more exposed to retail cyclicality. Number 3. Microsoft, ticker MSFT. Microsoft is trading in the low 500s as of October 31, 2025, and it commands a premium trailing PE that reflects durable enterprise contracts, strong free cash flow, and a growing AI and Azure revenue mix. The company pays a small but steady dividend and has a fortress balance sheet that underpins long-term DCF models. Morningstar's fair value work shows that Microsoft's intrinsic value is higher in bullish enterprise AI adoption scenarios and more conservative in slower adoption cases. In plain language, better than expected Azure and AI monetization lifts the DCF case. Our practical verdict: Microsoft should be viewed as a defensive growth anchor. Add on clear signs of enterprise AI adoption and expanding margins. Number 2. Apple, ticker AAPL. Apple is trading in the mid-200s as of October 31, 2025, and it sits on a reasonable trailing PE compared with pure growth peers while generating enormous free cash flow from hardware plus a growing services business. Apple pays a modest dividend and runs large buybacks, which materially increases return on equity and affects book value per share over time. Morningstar's fair value updates have shifted upward with stronger services trends, yet some conservative models still show the stock near or slightly above fair value, depending on how services sustain growth. The DCF conclusion is this: Apple is a defensive growth stock with optional upside. If services expansion and hardware upgrades beat expectations, it's a core hold for many portfolios, but watch holiday iPhone demand and services guidance closely. Number 1. NVIDIA, ticker NVDA. NVIDIA is the most consequential name on this list, and as of October 31, 2025, it trades at a very high trailing PE in recognition of its dominant position in AI compute and data center GPUs. The company pays an almost negligible dividend and is priced for continued structural growth in generative AI infrastructure. Morningstar and major market coverage have raised fair value estimates as visibility into future revenue improved, but intrinsic value remains highly sensitive to GPU demand assumptions. Small changes to the revenue ramp produce large swings in DCF outcomes. Our pragmatic verdict: NVIDIA offers the biggest upside if data center demand holds, and the biggest risk if demand softens. Treat it as a trade you size to conviction and hedge accordingly. A few practical trading rules that turn these fundamentals into action. First, always compare market price to fair value models. If price is materially below credible Morningstar or analyst fair value, a DCF argument for buying becomes easier. If price is materially above, you are buying optimism, not current cash flow. Second, make the single catalyst rule your checklist. For each name above, write down the one event that will change your thesis. Inventory or earnings beats for Chevron and Amazon, net interest margin for JP Morgan, trial results for Eli Lilly, cloud margin for Alphabet and Microsoft, and GPU data center sales for NVIDIA. Third, size positions to volatility. Treat Tesla and NVIDIA as trade-sized until they prove steadier, and consider Apple, JP Morgan, and Chevron for larger core allocations if you prefer lower day-to-day swings. Fourth, always include risk limits. A DCF isn't a guarantee, it's a model. Move stops and sizing as catalyst resolve. Closing notes and final reminder. The valuation numbers I referenced are approximate as of Oct 31, 2025, and come from widely used market data and Morningstar fair value coverage. Thanks for watching. If one of these names jumped out at you, smash the like button and subscribe to Seven Hills Equities so you don't miss any new videos. See you in the next video.